Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. As always, been pretty interesting watching the markets fluctuate. Actually look pretty healthy. We'll talk a little bit about that a little bit later in today's show. I think the backdrop is pretty good over the next few months. Where I get nervous is if I'm looking at the stocks that are making big moves in the short run. There's a scan that I use for that. And when I see that their valuations are really high, then I get a little bit worried. If the valuations are not high, not so much. So we'll talk a little bit more about that a little bit later in today's show. Right near the end of the show, actually, the last 15 minutes of the show, we'll get into the individual stocks, the ones I see moving, and kind of just the observations that I have. You can learn a lot just by watching. And when you've been watching for an incredibly long time period, I think it's been about 32 years for me now, you pick up things. So we'll talk about that a little bit later. And I was just, I continuously am amazed. This first segment, I just kind of like to talk about what is going to be pushing the economy forward. And it's always been technology, incidentally. Technology has always been the thing that drives us into the future, drives future growth. And but you don't want to just buy and hold a technology stock. We'll come back to that a little bit later. You need to manage the risks. And today the risks, they are pretty high. I mean, the valuations are not super cheap. I don't think the stocks are that overpriced given the interest rate environment that we have right now. I mean, the interest rates are incredibly low. I was looking at a lot of money market accounts yields the other day, like 0.1%. Wow, that blows my mind. Actually, the management fee on a money market is higher than the yield, or actually it's so high that the yield, that's why you're getting 0.1%. Now, just to put that in perspective, 0.1% in a money market. If you had $100,000 in a money market account and it's getting 0.1%, it's going to give you $10 a year. On a, is that right? No. I have to take it back. That's $100. $100 a year. So you got $100,000. Okay, 1% of that would be $1,000. So since you've got 0.1%, you're getting $100 interest. Sound exciting? And that's one of the reasons that we've been talking about some alternatives and how you get income in an interest rate environment that is as low as this is. And that's actually the middle of today's show. We'll come back to that. There's some guaranteed programs out there. There are a lot of them now. I mean, there are tons of them. But their interest rates on those, or the returns that you could expect to receive, are significantly higher than that. Some of them don't have a whole lot of risk. Some of them have a lot of risk. So you got to be careful with that. But again, we'll come back to how do you deal with low interest rates. And that's the middle segment of today's show. I'm trying to break it up now to where the first part of every show, I just talk about the economy, what's driving things, what kinds of things are going on right now inside the economy, things that you may not be able to see because it's not obvious. Okay, and then the second segment of the show, we'll talk about how do you deal with fixed income? What kind of options do you have to do that? Because that's a big part of most people's portfolios, or at least it should be. Because if you have 100% of your money in stocks and the market decides to take a 50% dip and take 10 years to recover the way that it did in 2000 through 2010, that can be problematic. 50% drop that takes 10 years to recover. Actually, it had almost fully recovered and then went down further than it did the first time. So how do you survive that? That's a key. And it's, how do you survive that without going broke? So that's the second part of today's program. And then the last part of today's program, we'll talk about some individual stocks, just because I like to do it. And it does give you an idea of what the institutional money managers are thinking. When I'm looking at these scans, I'm going into the stuff that's moving up right now. Right now. And when I'm looking at what's going up right now, it's just a reflection of the current mindset of the big institutional investors who basically move the markets. It's not individuals anymore unless it's GameStop, GameStop rather. But it's huge money managers out there that basically move stock prices up or down or bond prices because they just have so much money under management. That's another thing that's kind of crazy when I'm looking at this stuff. And we're talking in the trillions now. The top 3 asset managers manage more than half the money. Just 3 firms managing over half. That's one of the reasons I like to watch these scans, because I don't have to call anybody. I can see what they're doing inside the market. And as soon as we're able to, we'll have another seminar. And I'll show you how I'm doing that. It's really kind of cool, I think. There's a tool I only pay $50 a month for. And a lot of people go, $50 a month? Yeah, well, not for this one. That's incredibly cheap to be able to look into the markets behind the scenes this way. And again, get an idea for what is going on. And it's where I come up with a lot of the themes that I see when I'm reading. When you're looking into financial news, if you're scanning it kind of the way I do, I look at things that, for trends in sales, trends in profits, what kind of industries are growing, what kind of growth rates do they have. You can pick that up if you're doing it fairly consistently. And actually, you don't have to do it all that consistent. Once or twice a week is fine. But you want to spend some time every week just keeping up with that. I don't know, a couple of years ago, we were talking about the semiconductor stocks. Why? Because half of all the stocks that were making the lists, are making it into my scans, were semiconductor stocks. And I'm looking at it, I'm looking into some of the names, and I'm seeing how fast their sales are growing. And then I look at the industry, and I see how fast the entire industry is growing. And it's one of the fastest growing industries in the entire world. So I'm like, I wonder how I can take advantage of that. I know. You can actually get some broadly diversified funds that include technology, including semiconductors. That's a good way to do it. It's a safer way to do it. You could put a specific model together that's going to give you a lot more fluctuation because you're only investing in one industry when you do that. And not a whole lot of people have the stomach for that, by the way, to have a bunch of money concentrated in one particular industry. It fluctuates probably twice as much as the average fund's going to fluctuate. So you have to have a certain personality to want to put up with that. And what I like to do is keep it as a relatively small portion. So 10% of the money I have in stocks, that's my answer to that. So when I do it that way, I'm like, it's only 10% of the money that I have allocated to stocks, which is not 100% of my portfolio anyway. And it's spread out over several hundred, actually, I think it's close to 1,000 companies. So I think, what's that, the belt and suspenders approach to taking on a little bit more risk. But so anyway, I'm just rambling on here. And I just keep reading, and it's so fascinating. There's so many different sources, by the way, now that you have YouTube. And a lot of companies, there are still a lot of really good magazines, and I like to be able to buy a lot of magazines. It's because, number one, I'm probably a little old-fashioned, but number two, you can bring that on a plane and not get in trouble with a magazine. I guess you could probably roll it up and hit somebody over the head with it, but it's really, there's not much danger in having a magazine with you. It's just easier. So I still buy a lot of magazines. I think there are a lot of good ones out there. Scientific American is a good one. Massachusetts Institute of Technology, that's a good one. MIT Technology Review, rather. There's The Economist, that's a good one. There's Barron's is pretty good. The Wall Street Journal, that I just scan anymore. I don't really read that from cover to cover or page to page like I used to. I just look for headlines that I think might be significant. And I'm telling you what we are going to have, if we don't already, I think it's probably already upon us, but a major skilled labor shortage. A major skilled labor. What am I talking about with skilled labor? Well, anything that has to do with electricity. Now, the other trades, by the way, there's huge demand there too, and we can't fill those jobs either. If I'm talking to a high school kid that doesn't want to go to college, and you need to go to vocational school, get a set of skills because they're high in demand. And it's from all over. I mean, when you look at plumbing, have you noticed plumbing lately? Going through some of the model homes, the newer model homes, they're using polymers to make the tubing instead of copper. So they've got pipes. They're not actually pipes. They look like hoses, actually. And that's pretty wild. So you've got to know all the old stuff, and then you have to know all the new stuff. You won't learn that in 1 or 2 years, by the way. You're going to learn that over 4 or 5 years if you work really hard every day. And that's not what a lot of kids want to hear. They want to hear, I'm going to make $75,000 right out of high school with no skills because I'm special. I hope you are, and I hope you get that money. But the smart thing to do would be get some skills that are useful, and understand it's going to take you a while. And understand this: you're going to be relearning your entire life. And I would have been probably shocked, scared if somebody had told me all the relearning that I was going to have to do for this business. I think I would have chosen another career, but it's too late now. Anyway, it takes a while to be extremely productive, or it can take a while. You can get into some industries and learn right away and get up to speed and make a pretty good buck fairly quickly. I think the auto mechanics schools out there, all the electric cars coming, you want to talk about change. Holy cow. Those guys are electricians and engineers. And I could see a lot of kids going to engineering school that really didn't like engineering and then working on cars because it's pretty cool and they're really fast. And it's they're going to be they're already a lot like the old computers were. I used to get this magazine, Computer Shopper, and people say, what does this have to do with investing? Well, it does. I'm going to tie this in a little bit. But the Computer Shopper was a huge magazine. It was about 1.5 inches thick, had probably 500 pages minimally, and it came out once a month. And it was all the people that made components so that you could put your own PCs together. Think about that. That was in the mid-90s, Computer Shopper magazine. And it was one of those, a product tabloid. That's like twice the size of a normal magazine. And it was 1.5 inches thick, and it was every month. And it wasn't uncommon for people, if you wanted like the fastest, best, highest model computer, you had to build it yourself. The components were out there and available to the general public, but the big firms like Dell and Compaq, which doesn't exist anymore, IBM, they were very slow to be able to change and respond. We didn't have this, what do they call it? The super fast fulfillment of orders. That didn't exist. The infrastructure wasn't actually there at that time to do that sort of thing. So today, you would be, if you're doing that, it's because you just like fooling around with that electronics, because it's probably going to probably cost you more money to do it that way. B, if your time is worth anything at all, it's going to cost you more money to do it that way because of the time that you'll spend. And C, you can go around and shop online and you can find something to fit your bill immediately. So what does that all mean? Well, it's the same thing with cars. Cars are actually you're going to be able to take a component out of the car and replace it with a new one. And the car is going to tell you when that piece is wearing out. So you're still going to need to be a mechanic, because I am not going to touch the wrong wire and electrocute myself. And by the way, I was talking to somebody in the industry, who was going around the country trying to encourage high school kids to go through their curriculum for auto dealers to learn how to fix the new cars because they're dangerous. And you need a lot of training to do that safely. I mean, you can do it, but you can teach yourself how to jump out of an airplane with a parachute too. And I'm sure there's a YouTube video on that somewhere. But you could probably teach yourself to do brain surgery. I would probably get some training before I would actually start working on those cars. Just a warning. But the training's out there, and they're looking for people. And you can get money to go to school. You can take out student loans. You can get financial aid. You can get grants. You can apply to a lot of the colleges. If you take some of the courses that are relatively cheap online, you can get scholarship money. So it's there, it's available, and that is what is moving. That is moving the economy forward now. People are doing this as we speak. So once you get trained in a field, everybody's going to be lifelong students now. You just don't have a choice. You have to learn more stuff. You have to do more stuff. Like I said, I'm not doing hardly anything I used to do in the same way. I don't think we do one single thing. Now, a lot of our custodians won't accept paperwork. You have to do it online. Everything. That blew my mind. Anyway, I hear the music. That means I have to take a real quick commercial break. You listen to Bill Bullington right here on 1420. Stay tuned. I'll be right back.
I filled my heart up, sitting on top, winning, but that ain't winning. I've chased all the good stuff, all the bad stuff the world calls living, but that ain't living. Hey, don't really matter what I do. Hey, don't mean nothing without you. I don't wanna have it all, write my story any way I want. Everything will just fall apart if you waited.
And welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also find this show as a podcast on 955thefish.com, or you can go to my website, bullingtoncapital.com. It's there every week. We upload it. And you can also reach out to me there if you have any questions regarding retirement income planning, getting ready for retirement, how much should you be saving, what should you be investing in now. Any of those questions will be free to, the answers are free. You can set up a complimentary, either a phone call or a stop into my office. There's no charge for that. So anyway, we were talking a lot about same kind of stuff. It's what's really interesting. Markets haven't changed as much as people think they have. The way that we buy and sell stocks has changed big time. But the volatilities are about the same. Actually, the volatilities were probably higher in the early 1900s than they are today. And in the early 1900s, it was more common for a stock to sell at a valuation that was a lot further removed from the actual value of the company than they do today. Now, when I say that, and the younger people in the business are going, "Oh, that can't happen." Nope, look it up. I'm telling you, stocks sold at valuations. I think that it was Alexander Graham Bell's company, which I believe is still around. I think it's part of AT&T now. In the 1890s, that stock was so overpriced that by the time it had crashed and recovered, World War II was over. Think about that. 1890s to after World War II. That's a long time to wait for your stock to come back. But the story, the same story that GameStop has, or any stock, Beyond Meat, all these stocks that go up beyond. Actually, a lot of stocks will get overpriced, even though they're good, solid companies and been around for a long time. Those stocks will get overpriced at some point in time too. But I really like what I call the story stocks, those stocks that pull so far away from any valuation metric that you could possibly come up with. They're so much higher than that it's just the story that keeps it going. And by the way, in the 1890s, you'd have a hard time convincing somebody that a phone actually worked, that it wasn't a trick. That's what people thought. You cannot talk into this little device and hear somebody from across the country or across the state or even across the street for that matter. So it took a long time. And then when people started accepting it, well, the story was, who the heck wouldn't want a phone? Yeah. But when the share price gets so far ahead, when they're figuring that everybody's got two phones now, and the reality is less than a quarter of the population has a single phone or has access to a phone, well, that's called getting ahead of yourself. Financially, that is a really tough thing to do. I mean, for an investor who buys and holds. That's why I'm not a big fan of buying and holding. I'm a big fan of buying and holding funds, especially today. Today, you've got funds that buy and sell based on valuations. You have them that sell based on the underlying values of the companies. I really like those. I like them a lot. There are a lot of funds who, in fact, the S&P 500 is an index that's derived mostly off of price movement. Now, I know they didn't think that they were doing that at the time they had come up with that idea. And if they had thought about that and where it might lead to, they probably would have changed it a little bit. Okay, but the S&P 500 is a group of stocks that supposedly represent the stock market in the United States. It doesn't. It actually represents the top 50 companies that make up that index, because the top 50 companies make up more than half of the value. Heck, the top 10 stocks out of 500 make up about a third. That's diversified. Yeah, you're actually making a wagered concentrated bet when you invest like that. And by the way, the bet's been pretty good because it's been in America. And America rewards risk takers. And that's one of the reasons that you have to have some stocks in your portfolio, unless you're happy getting less than 1% interest on a savings account. If you're happy with that, it's because you're a billionaire. Or at least you're worth $100 million and you can live on $100,000 a year. That's what you get when you get 10 basis points. Keep your money safe. So most of us aren't in that shape. So most of us will never be in that shape. So I don't feel like you have a choice. On the fixed income side, since I brought that up, I like to take a little bit of time every week. There are options. There are immediate income annuities. There are fixed indexed annuities. That's actually my favorite out of that group, because you have a chance of earning a decent return. But if you don't earn a return, they have a floor, a guaranteed income rate that they will guarantee for your lifetime. They'll guarantee you can add other features to it. And that, by the way, it's been around for a while. But within my career, they've really grown that business and made them much more flexible. In fact, there are two types of annuities that I like a lot. There's the fixed index that guarantees an income, and I have it. By the way, when I'm talking about something on my radio program, I'm already invested in it. So I invest in everything that I talk about here. And I'll have money in everything that you have, unless you come in and, by the way, if you want to do individual stocks, we can set up a separate account for that you want to pick. We don't build that. So if you're a client, that's the catch. You got to be a client. If you're a client and you want to do some stocks on your own, I have no problem. You can call me and ask me about it. You can make all the buys and sells yourself, and you can ask what my opinion is if you are a client. Okay, so that's the key. You got to be a client. And otherwise, I'd never have any time to talk to any of my clients. So anyway, fixed index, I think it's a great idea. If you want to see an example of one of those, email me. I'll send you a link to my favorite. My favorite is Nationwide, because the guarantees that they make, I feel like, are the highest from the highest quality company. There are a lot of companies out there that have these products, but a lot of them may not be on the same financial footing that these guys are. And that's something you want to pay attention to when you're looking at any type of annuity. What is the financial strength of the company standing behind the guarantees? Because they are standing behind the guarantee, not the U.S. government. That's the thing about the Bitcoin and digital currency. People just don't seem to understand. Nobody is standing behind the currency. And by the way, the people that are doing the transactions with you, you don't know who they are or where they are. And that was part of the allure. I thought it was also really dumb, but the really aggressive, I guess. And people, they want to believe in it, and they're going to believe in it, and that's fine. I'm not going to argue with it. Go ahead and lose your money. That's up to you. Yeah, you want to take that chance. Read what Warren Buffett has to say about it. Read what anybody who knows a whole lot about investing has to say about it. And I know some people, I bet I got rich on that. Yeah, people got rich buying and selling tulip bulbs in the 1700s too. It's the same thing. This one's actually a lot smart. It takes a lot more programming skills to be able to participate if you're going to be a miner or something like that. But anyway, long story short, as long as if the U.S. government doesn't stand behind it, see, the U.S. government has this thing called the military. They can go in. Not that they ever would. Not that it would ever escalate. Hopefully it never escalates to that. I mean, it could. In the realm of all possibilities, all things are possible. That is not probable. But having the United States standing behind it. See, the United States has two things that make it a really good risk to lend money to. Number one, they own this thing you might have heard of. It's called a printing press. They can print money at will to pay their debts. They're legally allowed to do that. We're not allowed to do that, but they are. Okay. You can't print. Well, actually, you can print your own money. It's called Bitcoin, and it's not a print. It's a digital print. And that's about what you don't know who's standing behind it. And boy, I'll tell you what, if anybody ever captures all the activity that's not being reported, the people that are losing money, that are having their money stolen, having their wallets disappear, having bogus transactions go through, that'll slow down pretty quickly. That'll slow down very quickly. And the main thing is you don't have the United States government standing behind it. And people say, well, banks don't have yes, they do. The banks have the FDIC. The banks are regulated. They have to watch. They have to report to someone. And their reporting is intense. Not a little bit. It's a lot. One of the draws to Bitcoin was, we won't tell anybody. No one will know. I'm just thinking, well, that's great. What do you do when you lose your money? How can you prove you ever had it to begin with? Or where it's gone. Well, it's untraceable. And by the way, they say it's untraceable. It is actually traceable. That's a misnomer. And I know I'm going to get calls from programmers that say, no, it's not, blah, blah, blah. No, yes, it is. And if you were an extremely talented programmer, you would know how to bust that code. So give that a whirl. Anyway, I'm going to stop talking about that because I know I've probably just upset a whole bunch of people who own, Bitcoin, and it's okay. It's not, just don't put all of your money in there. Don't put enough of your money in any one thing that if you lost it would have a big impact on your life. That's the key to diversification. And I do a lot of things that are kind of crazy. Actually, I just sent some money to invest in Boxable. I've talked about that for a while. That's another big change that's coming. The housing market, how we build houses, that's going to change. I don't know that Boxable is going to be the one. I think they'll have a big impact on the way future housing is going to be built and transported and put into place, and the materials that are involved. That's going to have a big impact. And I think these guys have a pretty good shot. So if I lost 100% of the money I sent in there, it wouldn't make one bit of difference in my life anyway. So like almost every other investment I make, collectively, if they all went bad at once, the chances of that happening are almost as good as the Browns winning the Super Bowl next year. Yes, so, and that's what you really want to do is learn how to manage risk. That's actually what portfolio management is. It's not identifying the big winners. The big winners are out there, okay, but they're few and far between. You want to manage the risk along the way, you put yourself in a position to get lucky, and that's what most mutual funds are for. Exchange traded funds I use mostly now. But some type of fund that's got an algorithm that says, okay, the stocks that have a tendency to do well over time have these characteristics. This is what they do. They have sales. That's a good one, right? It's nice to have a company that's got sales, because if they don't have sales, how do they stay in business? How do they pay their bills? Okay. Got to have sales. Sooner or later, I know a lot of businesses will come out with no sales. Actually, that Boxable, they have no sales. They've got orders. They're taking money for investments. That's why it's on the pinnacle of risk. Actually, I put the risk of Boxable about the same as Bitcoin right now. Why did I invest in it? Well, because my dad was a carpenter, my dad's dad was a carpenter, and my great-grandfather was a carpenter. And so I grew up going to work when I was a little kid every summer and all the way through college, and actually about a year after I got out of college. So I know a little bit more about that industry than a lot of people. I like what I'm seeing, but I knew I was taking a risk the minute I wrote the check. Actually, the minute I decided to write the check, I knew I was taking a risk. But go to Boxable.com. I think it's pretty cool. I think this is probably maybe this is the first. It's probably like the Commodore computer. It was the first of the computers made for the general population. And this may be the first iteration of a new trend in housing. And if it does as well as I think it could, I think I'm onto something. Otherwise, I wouldn't have invested in it. And by the way, you have to be an accredited investor to get in at one level, and then there's another level that you can get in as an individual investor. It's through a filing called Reg D. They can sell stock before the company becomes public directly to the public. And the idea there is that you get a little bit of a discount. So if you have any questions on that, feel free to email me, and I can email you the website that you can go look around and read all about it. You'll probably still have questions, but they have people that can answer questions there too. And it's just a really interesting, fascinating concept. And Elon Musk, that crazy genius, is supposedly living in one of their units in the parking lot of one of his factories. So anyway, I hear the music. I got to take a real quick commercial break. You're listening to Bill Bullington. Stay tuned, because I will be right back.
Does he understand? Sometimes I question if he's able. Can he rescue? Can he save me again and again? But when I look back, did he move every mountain? Did he part every sea? Yes, he did. So yes, he can. I heard your heart, I see your pain. Out in the dark, out in the rain. Feel so alone, feel so afraid. I heard you pray in Jesus' name. It may be midnight or midday. It's never early, never late. He gon' stand by what he claimed. I lived enough life to say help is on the way, round in the corner. Help is on the way, coming for you. Help is on the way, yeah, yeah. I lived enough life to say.
And we're back. Hey, just I got up on several tangents there, like I normally do. Please don't take offense at anything I say. It's not worth your time to get mad over it. You're not going to change my mind, number one. Number two, you've got a right to your own opinion. And I don't mean to offend anybody. And it's my opinion on certain things are kind of strong, and it comes from experience. And, maybe I've just had really bad experience with some of this stuff. And so that's why I'm not as high on it as some other people might be. And you live and learn. So most of us have to learn the hard way, actually. And I'm probably as hard-headed as they come. So I get it. But having said that, before I go into the individual stocks, I just wanted to take a second to talk about there's an annuity out there that I've nicknamed the Gumby annuity, because it's so flexible. You can put money in, you can take money out. There's no sales charge going in or out. There's a management fee. You can invest in institutional funds, which otherwise you would not have access to. It's one of the least expensive annuities in the country. And by least expensive, I mean in expense ratios. You can add things to it like a guaranteed income. You don't have to have that, by the way. That's not mandatory. So you can add, that's why I call it the Gumby. You can put money in, you can take money out. Now, you got to be careful. You don't want to be doing this with money that you're not planning to use to supplement your retirement, more than likely, or maybe to leave to a future generation. And you just like to not have to pay taxes on it. When you have these types of annuities, it's a variable annuity, but it's a no-load variable annuity. So you can switch around within the annuity itself. That 350 funds there, Vanguard, Fidelity, T. Rowe, you name it. It's in there. A lot of really, really good funds are in there, I should say. Every category is represented. When you make changes, you don't get 1099s on that. When you start to take income out, you can set it up so that only a portion of what would be distributed would be taxable. If it's a non-qualified, that means it's not an IRA. When you take money out of an IRA, it's taxable. So it doesn't give you that protection if it's not a non-qualified. Non-qualified means it's not an IRA or an IRA rollover. So you can lower taxes. Oops. You can lower your taxes. You can have all these choices of funds, and you can add to it if you want to. If you want to add a rider on there that will guarantee a minimum income, that's pretty good. I think between the fixed indexed annuities, which are really more of a should be used for the stuff that you want more guarantees on, and it's going to be pretty solid and is going to give you a certain amount of income that you can count on, then that should be used as a replacement for a portion of your bonds in your portfolio. You could use it as a portion of the bonds. This would be for the stocks, and it's got a bond-like feature on there where it'll guarantee a certain amount of income. The income rider today is a 4% income. Now, here's that's going to be lower than the fixed index annuity, but here's the advantage. You could put 100% of the money in stock, and if the stock market crashed, they would still pay you 4% on what you started with. And what they would do is going forward, if the account, let's say the market didn't crash right away, let's say it actually went up and doubled over the next, let's say 7 years. Okay, and that would actually be a really good run, be about 10% a year. So now I've got twice the amount I started with. It'll guarantee the 4% on the twice what you started with. And if the market crashed after that, so what? You still get 4% on the 2 times number. So that one actually has a chance to go up. Okay. The other one's going to start out higher, but it's going to stay fixed. That's why they call it a fixed indexed annuity. And this one is an investment only annuity, and that would be a rider. You can also put some, there's some other riders, they're always changing these things, by the way. I thought school was over a long time ago, and wrong. They keep thinking of more things to do. Some of these you can actually add death benefits to now so that you can not only take care of yourself, but you can look out for your beneficiaries. That's kind of cool. Every time you add something like that on it, by the way, there's a fee. These fees are normally much smaller, and they're very transparent. A lot of annuities are very difficult. Even the fixed index, all the fixed index annuities are incredibly difficult to figure out exactly how much you're paying. That's why you want to concentrate on the fixed portion, the guaranteed portion. I don't even think it's worth your time to learn how to read the rest of the prospectus. Just concentrate on the fixed portion of that. The variable part, you can use one of these investment-only annuities or just a regular portfolio. The investment-only gives you a good tax shelter. If you're at a pivotal place where you're just on the border of having to pay higher taxes, you might be able to defer the dividends and capital gains from the mutual funds. You may even get the exact same mutual funds you have today, but instead of where they are, they would be inside of a tax-deferred vehicle, and you wouldn't have to report those capital gains or dividends. That's pretty cool. So now, if you've had it for a long time period, there's a cost basis, so you got to figure out what the capital gains tax might be to make that switch. That's a big part of it. And I'll tell you, one of the guys that does a really good job of calculating all that stuff is the guys on the estate planning team that do a show here. They will sit down and do that for you, with you if you're one of their clients. Yeah, and oftentimes they're going to call and ask me for all the backup data, which is kind of a pain to look up, quite frankly. But the work that they're doing is actually a bigger pain. So I'd rather have them guys do it. I'll come in with the investment and the ideas and the management of the assets, which is that's a vocation by itself. And you have to be familiar with a lot of stuff, though, when you do what I do. It's always changing, and there are new opportunities coming up, just like these products. It's amazing. It's absolutely amazing. So if you would like more information on that, feel free to hit me up. Remember, there's no load in, there's no load out. You don't get penalized. There's no sales charge. We charge a 1% management fee. That's it. Pretty low for what we're doing. Could lower your taxes quite a bit. You could use this for legacy planning for your beneficiaries down the road. All kinds of stuff. It's unbelievable all that you can do with that. Particularly since they removed the penalties for changing your mind. The fixed products have penalties because their guarantees are so much higher that when they let somebody out of a contract, it costs them money. So they have to pass along some of those costs. So you have to decide whether or not you think that it's worth it for you. Anyway, I was going to, and I am talking about stocks. And you know what? I just ran the scan. I shouldn't have run the scan this early because the number of stocks that would qualify is probably going to go up a lot by the end of the day. And so sorry about that. But here's what I'm looking for. I'll go look at the last 30 days, the last 90 days, and the last 6 months. I'm looking at the stocks in the top 20% over one of those time periods. So oftentimes it's in all three of those time periods. So I'm looking at those stocks, the top 20% of all stocks in America whose share prices are up 3% today. So I'm looking at stocks that are going up whose share prices are still going up. Because how do I know they're still going up? Well, they're up 3% today. Yeah, 3% is a pretty decent sized move. It's not a huge move, but it's a good sized move. And right now, as I'm looking at that, I'm just looking at the 3 month. This is the 90 days. Over the last 90 days, there are 13 stocks so far that meet that criteria. Now, when I do this during the day, I take the volume off. I also like to see that the volume is above its average volume. So what am I looking for? I'm looking for stocks that are moving up really fast right now. And it's interesting. If I look back over my career, that was the total opposite of what other people wanted. They wanted stock to buy low and sell high. They like to pick their stocks from the stocks making the new lows. That was the way it was 30 years ago. And most of those people are not around anymore. But that strategy is pretty tough. It's like catching falling knives. You just don't really know if that's the actual bottom. So what I decided to do was, after studying and talking to a bunch of wholesalers from a bunch of other mutual funds, so I was very lucky to have been able to talk to a lot of these portfolio managers personally. And they would look for things that were moving now. We want to see this thing going up right now. That makes sense, doesn't it? So that you can increase the odds that you make money sooner rather than later. And yeah, it's great to be like a Warren Buffett and I want to buy and hold forever. And that's fine if you're buying the whole business and keeping the cash that the business is generating. But most of us are not in that position. And by the way, that is really tough to do for an awful lot of people. Coca-Cola is selling at a price that's slightly lower than it was 30 years ago, and that's his largest holding. And he doesn't care, by the way, because he bought it a lot longer than 30 years ago. 20 years ago, I'm sorry. He bought it a lot longer ago than that, and has a big gain in it, and his dividend right now is probably close to what he actually invested in the stock. So that's fine, but if you're looking to not have to be down a whole lot over an extremely long time period. You either use funds who make changes along the way, or you learn how to do this. And I think the funds are easier and they're safer and they're constantly being managed. This is something that you should do with just a little bit of your money. So I'm going to run through just really quickly the way that I do every day, and try to see if I see anything. There's something, NOA, NACG Holdings. I like the look of the chart. It's great. It's an oil and gas company. This one's funny, Papa John's Pizza. I've been in and out of that thing so many times because it shows up on a scan, comes in, and occasionally it makes money. Sometimes it doesn't, but it's up, and I really like the symbol on it. It's PZZA for pizza. Let's see here. QDEL, this is a diagnostic company. It does diagnostics research. I'm sure actually this thing really got hammered in the last, it peaked in 2020 after running way up, after the pandemic. So that's interesting. That stock's been around for an incredibly long time period, and it has a really good looking chart. So those are actually, I think, the only ones. Domino's Pizza, by the way, has got a really nice looking chart. The valuation's a little bit high on it, but it looks like it's doing pretty well. So anyway, sorry I didn't have that much time to do that. And by the way, since it's only 10:17, there's that's why the list is so short. But if you want to see a full list of this every day, there's a website called Look Out for the Bull where Mike runs these scans and publishes it every day. So if your goal is to try to make money sooner than later, you'd probably do really well to concentrate on that list, because those are the stocks that are going up right now. Anyway, I had to hurry that up, and I apologize again. I'm always cutting this segment short because I have too big of a mouth, and I keep and I have a mind that goes in a lot of different directions. That's an occupational hazard of working in the financial services industry, by the way, because it is constantly changing. If you don't like change, stay out of this business. Now that I hear the music, that means the show is definitely over. Thanks again for listening, everybody. This is Bill Bullington here every Saturday morning from 11 to noon. Go to my website, bullingtoncapital.com, to reach out to me. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.